All right. Today, Tuesday, May 2nd. And it sucks to be a Rangers fan today. And it's good to be a Devils fan. But what can you say? Other than the Rangers continue to be a fucking retirement home for superstars. That's it. I mean, that's all it is. It's sad. I mean, Devils are doing it right. They got a good team, and they're going to go deep. I wouldn't even be surprised if they go through Carolina and whoever else. And so that's it. So we hang up our Rangers jersey, and then we go put our Devils jersey on. So, I mean, that's what I do anyway. I don't care. I mean, I'm not one of these bonehead people who like want to wish ill on any team. I don't, to me, I don't care. I just want to see good hockey. And Devils are fun to watch, man. They are fun to watch. So, anyway, needless to say, my Ranger woes, but got a few earnings coming out this morning, which I didn't do anything with, and I didn't do anything yesterday because I wasn't planning on doing anything this morning. So, with Uber, Pfizer, BP, Marriott, Marathon, a few of these others. But I am planning to try and do something on some of these tonight, Tuesday night, which is AMD, Ford, Starbucks, and that's probably about it. The others, Caesars, we'll take a look at. And then Wednesday morning, we have CVS, Yum, Barrick Gold, Wingstop. I don't know if anybody knows the place sucks. I don't even know how they're going to stay in business. The place is garbage. Sun Power, period. But so anyway, right out of the gate, looking at a few things. I see bonds, I noticed, and I posted it up this morning. Bonds with a really nice rally today. Literally, pivots matter, folks. They really do, even in the bond market. I mean, overnight, we literally come down, tag S1, and bounce, and have been bouncing. And it is a nice rally after a pretty significant sell-off yesterday in those bonds. And I think more of yesterday's dump was more related to this SVB thing with the write-off that JP Morgan is going to get for taking over SVB. I think this was more of a reaction to that than it was anything else. Just again, that's just my opinion. I still think there's a significant amount of demand out there for bonds, and presumably it's yield. Again, it's why am I gonna? And again, it's not Joe Sixpack, and it's not even Trade Room Hustler or anybody else, or people in investment firms, whatever. It's big, large money saying, look, I can go sit in a treasury bond at 3.5%, 4%. No risk, right? Other than the risk of bonds going up, but really no risk to sit with the potential that, look, rates rising is probably, near the end. Let's face it. I mean, they've kind of sent up the flares already. That they were pretty much at the end. I mean, maybe we have one coming up this week and then possibly one more maybe after that. And I think they're done. I think they just stick their guns in their pocket at that point, and then they just let things kind of go. Anyway, so that's just that as far as, and I think bonds actually have some potential here to just, at least rally back up to April highs, 134. So again, it's not a huge run, but again, there you have it in the bonds. As far as other trades go, I have not done anything. We have been, look at this. I've had these alerts set for quite some time, and we are just really stuck. I mean, we are, especially on the Russell, we are stuck in a range. And that is kind of the story there. Let's get out of there and get up to the big screen. But that is the story there with the bonds. I mean, with the Russell, is that we are just stuck, failing to break out, failing to break down out of this range. I'm not talking about like making, previous highs or previous lows, but we have been pretty much stuck since March. And we're going into May, and it's just been a chop house. Now you look at the NASDAQ and look at the ES. I think you're getting a real bad picture of what is going on in those markets. And it's funny, and not that I'm some kind of, I feel like I'm some kind of genius, but since I mentioned just 2 weeks ago when I started doing this again about these indexes being completely overweighted, 5 to 8 stocks. We'll call it, I was saying 5 to 10. It's more like 5 to 8. And specifically, it's like Apple, Microsoft, Amazon, Google. Let's just call it that. Way overweighted. And then a story came out, I want to say Thursday last week, about 14 or 15% of the S&P 500 is Apple and Microsoft. So what is that? How is that an index? How is that an index? And it goes back to when I see people out there, especially investment professionals, just say, just take your money and just go put in an index fund and blah, blah, blah. Yeah, well, you know what? Yeah, that was great. That's been great. And it's been great. But let's face it, these index funds, SPY has only been around since 1990. It's not like it's weathered the course of a 100-year cycle. In fact, none of these companies that are actually out there, other than maybe 3 or 4, so like some of the oil companies, which were actually derivatives of, Standard Oil, and they're all different now. And so, don't be so triggered to go and dump your money in an index fund thinking you're getting diversification when you're not. You're basically buying Apple and Microsoft and a basket of other stocks. That's not an index. And so I think we're getting a real bad, false impression of how the market is actually held up. And I think that's why you need to follow the Russell, because it's a better diversified basket of stocks, smaller stocks, mind you, but at least the weightings are relatively flat. There's no real one. I think the largest, I haven't even looked, and I should go look before I even say anything, but I believe at one time one of the largest allocations in the Russell as far as the sector was financials, and that's why it got hit so hard when the financials kind of got wrecked. So if there is a weighting of the mid caps, it's probably weighted heavily to the financials, which I think is probably more indicative of what the markets are out there than being tech heavy. Because let's face it, the banks, so go everything. Banks start failing left and right, folks, and then the whole thing collapses. We know that. So anyway, that's why it's always best to just follow the Russell. If you're really looking at the indexes and trying to get a feel for where things are, the Russell is the where to be. The NASDAQ and the ES are fine if you want to trade derivatives of Microsoft, Apple. That's fine. And there's nothing wrong with that. But, the Russell's going to give you. So anyway, I'm not really seeing anything because we're just stuck. And so I really haven't been doing anything. I haven't done any trades either in a few days. Because there really hasn't been any entries that have set up that I feel that are worth taking advantage of. Now, the only one that I have, and I still have it from even the last broadcast I did, is this spot right here, which is it's about 1,800. Which today it's about R2 is 1797. That's a pretty big move from where we are. And I'm not really, getting too excited because I doubt we get anywhere near there. Because if the Russell gets up to 1,800 today, that is a big move. And so that's it. That's all I got to say about that. And I'm going to move on to some of these earnings plays, which, quite frankly, I'm actually the first time I'm even looking at any of these stocks in a long time because it's been boring as hell. First one up today is Uber. I don't know how they're doing. I don't know what they're. It does look like it's actually up. There's no trade here because you got IV rank of 9 in here in Uber, so there's nothing maybe as far as an after trade. I don't know if I'd really want to get long. I don't know how you want to get long a stock like Uber if you're not already long. I will say this, it has gotten the snot beat out of it. And but of late, it's actually done relatively well. And you can see here, I had my magic trend line, and it's already blew through that. But short term here, especially this is a 4-hour chart, this looks relatively bullish, especially after today with this big gap up after earnings. Now, I assume the earnings, they came out and they were pretty good. That's right. I mean, I don't know how I could assume otherwise. Did they come out yet? It's 7:45. Yeah, boost profits, blah, blah, blah. Good for Uber. Goober. And if you're actually one of these pattern traders, you have a pretty distinct, at least again on the 4-hour chart, you have a pretty distinct ascending triangle here. That if you're looking to trade this, I mean, this is literally going to be a point of resistance up here around 37, 38, or it's going to be a breakout. And if you actually manage to trade this and bought last night, you're sitting pretty tonight. But I don't know if there's really a trade in here to do other than, some kind of calendar spread. And if I was going to do anything, I'd probably be shorting this. I wouldn't even make this green. I'd probably be shorting this. Because I don't know how you can basically have a contracting economy on a company that's extremely consumer-based, regardless, and kind of buy at this point and be long. And to me, it's just kind of a pretty destructive. And that's not to say it can't go higher. Look, we've all been wrong before, but look, just based on the pattern and what I see and just how things are out in the real world, I just don't see this thing. I see 38 being a complete huge roadblock for the stock. And I'd be willing to stay, and I'm actually going to set an alert. Looks like it's 37.50. I'm actually going to short this over 37.50. So how do you like those apples? And that's just based on the earnings. That was really the only one that I had a play on kind of after earnings. All right, and there you go. And so Goober, Uber, Bloober, Uber, Goober. So there you go. There's Uber. I don't think it gets up there today. If it does, that's great. I doubt it. There's a lot of momentum and a pretty big move for this stock, especially a $30 stock, $31 stock, now $35. That's a pretty decent move for a Goober. So let's look at some of the earnings. AMD, I don't think there's going to be much volatility in much of anything, and which is kind of sucked. A 25.2 is actually like good, unfortunately. Yeah, I mean, that's actually good these days because IV and volatility has been like far and few between. For a market that's really kind of been relatively IV rank of 25.2 is actually pretty good when you have volatility or the VIX sitting at around, around 17 now these days. So let's take a look at AMD. I'm probably not going to do May. In fact, maybe I do a May, but let's take a look at the chart real quick on AMD because it is one that I follow. I have it in this list of big tech, which has actually done okay. We actually zoom in here a little bit on this, right? AMD pretty much in the middle of where it has been. I mean, complete huge recovery, right, in tech from the meltdown late last year. I mean, 60 to now 89. That's a pretty big move for anyone who's purchased AMD back earlier in the year, in the beginning of the year. If you actually bought that dip, that's actually a pretty nice move, and you're sitting on some pretty decent profits. Definitely probably have some resistance at around 102. So that's where I'll be going to be looking to sell some calls, maybe around 102, and probably down here at about 83. I'm going to be looking for support. So there's a couple of spots where I'm looking, and I'm looking outside of the expected move. Expected move is $8.39. $8.39 in May. $10.11 in June. All right. I prefer June only because I have a little bit more time. But I'll do May just to see if there's any juice to be sold here. And we threw out numbers, what was it, 102 and 83. So here's the expected move strangle, which is an 81. And I have to change my account because I got my IRA. And I don't get portfolio margin in my IRA, so the margin numbers are crazy. I don't think the margins are going to be that bad on this. I said 81. Yeah, 81 and 102. And 102 brings us out to the one standard deviation at 102 out here. We're only getting 86 cents. And so that is kind of that is probably the trade that I would look at to do in May. Not overly excited about it, only because 221, I'm going to use $900 worth of buying power. I can't expect to get a third of the buying power at an IV rank of 25, let's face it. And especially being out this far on the call side, out past one standard deviation, I'm just not going to be able to get the juice. I'm not going to be able to get the juice I need to make this trade profitable, or at least make it, to fall within the expected move. Now, it's obviously skewed here. Let's just bring up the curve, make it a little easier on the eyes. It's skewed a little bullish, right? Because oh, God. Oh, man. It's like clockwork, man. 10 to 8. There it is. There's the cron job. I mean, I'm telling you, every time I do this, the cron job at 7:50 or 6:50, I think they go by Central Time over there. But anyway, it is skewed a little bullish here. Right. And here's our analysis. This is I actually prefer not to have all this crap on here. What happened? What happened? So there you go. I would try and do this one for 225 just to snake a little juice out of it. Not really a great theta number here. Quite candidly, for a 7-day or 17-day option trade, at least to expiry, and bringing in 225 again. I gotta take what the market's giving me here. I mean, good probability of profit at 72%. Yeah, my problem with this trade in general is the fact I'm only bringing in 225 and I'm using $900. But again, you gotta go with what the market's giving you, and I don't think there's really any way. Now that's if I do May. If I probably go out to June with the same trade, probably going to get a bit more juice in there, but I'm going to have less theta. But we'll look at both. So let's look at the other one. Let's see if we bump this out one expiry and we bring it out to June. You could see in June now the strikes have changed because we don't have the dollar wides out in June. So that brings us to doing an 80, 100. I don't know if I want to do a 100. I'll do a 105. I'll do a 105. But to me, this is actually a really nice trade. Now, my probability of profit got cut by 10%. And you can see I lost theta. But I'm bringing in 380 and I'm using 824. And so literally I'm in the wheelhouse of that 1/3 of the buying power. So more than likely, I'm going to go with this trade. So I'm going to probably go with June. Maybe I do both. Maybe I do both. Only because I don't expect AMD to blow out or blow up. I do kind of expect it to stay within its expected move. But then again, look, I expected Microsoft to stay within its expected move. And I also expected Meta to stay within its expected move. And neither did. So, those trades have since come in because I stayed mechanical with them and rolled and did all that kind of business. And right now they're actually profitable trades because I stayed mechanical. But I think this actually gives me a little bit more flexibility. If it does blow up or blow out, I have kind of two things going for me with this as opposed to May. The May trade, I would be forced to kind of be very, very reactionary if one of the strikes get blown because I'm in May and I don't have that time element to kind of ride it out a little bit and maybe, squeeze myself. Where here, I at least have 45 days to kind of manage this through if one of these strikes gets blown. All right, so there's AMD, and that's for earnings. Again, this is one you're going to want to put on for 3:30. All these trades that I'm going to go through are 3:30 today trades, which is Tuesday. And so for me, it's going to be the AMD. It's going to be the AMD. So AMD. All right, it's a strangle. It's a strangle, and a strangle is just, it's a put and a sell. So you're going to sell, and you're going to sell a put, and you're going to sell a call. And basically, it's just a strangle. It's an iron condor without the wings. And you're going to do the 8105. All right, I should put in here that this is June expiry. All right, so it's June. Make sure it's June. All right, buying power is 825, which is good, I think, for this trade. You're going to do this for a credit of 380. Not bad. Pop on this is 66%. Right. Greeks are okay. Again, Delta is positive. It's a we'll call it a +4, 398. I'm going to get technical. And Theta, I wish it was better, but it is what it is. It's a 9.5. Again, not great. I wish I had a little bit better. Problem is you don't have that theta in this because Ivy rank sucks. Ivy rank is definitely not, it's good compared to what else is out there, but your theta numbers are going to suffer for that because the Ivy rank is relatively low, and we have 45 days. So there you go. There's the trade. Pretty simple, right? So it's the June strangle. You're going to sell the 8105, use $825 worth of buying power. You're going to bring in $380 worth of credit. You got a 66% probability of profit. You got a 4 delta, so it's skewed a little bullish. Theta 9.5. And there you have it. So there's AMD. And again, you're going to want to do this one at 3:30 today. So start trying to put this one on around 3:30. All right, let's go to the next one. Let's see. We have Ford. I'm not even going to look at. It's the only thing you can do in Ford, let's just look at Ford real quick. The only thing you're really going to be able to do in Ford is probably sell puts. That's it. I don't think there's really much you can do with a $12 stock. I really don't think, because the problem with Ford is a few things. Let's face it. A few things wrong with Ford here is A, Ivy rank, bad, right? 17. That's a rough stock to trade. Being that it's $12, what are you going to do? And the problem with Ford is that I don't think you want to be short calls, because if it does move, you're not getting paid. You're really not getting paid. I mean, so let's go to June. If I sell a 13 call, I'm only getting 34 cents. Now, buying power is great in the stock, let's face it. But I don't think you want to be short calls in this if they blow out. An expected move of $1.19, because what you could do, and what might not be a bad trade here, and I wish Ivy rank was a lot higher. Maybe you do a covered call, or maybe a poor man's covered call. And a poor man's covered call is where you buy a pretty deep in the money option. Usually it's a delta higher than 70. And so what you're trying to do here is, with options, you're trying to simulate buying stock. And so in this case, I would probably go with the 10. So you sell the 10.13, or you buy the 10.13 call spread for $1.93, $193. It's a 50-50 shot. If it goes up, you'll make money, and if it goes down, you won't. So basically, and you're only using $100 to trade. Basically, what you're going to get 50. You're trading 52 shares here. So you basically cut your capital use in half if you're going to trade 100 shares. Right, so if you did 100 shares, it's going to be 1,200 here. Here for $193. Let's say I did this twice, just for argument's sake. For $400, I'm managing 100 shares plus for 400 as opposed to 1,200. Right, a lot easier use of capital. Right here, for if you're just going to buy, because I really don't see any other way to do this, other than, either buying the stock or selling some puts. But so I guess if you had something to do, if you want to do something forward here, you could do this. This is a poor man's cover call. You do the 10-13 call spread, do it twice. So you're trading 100 shares. The reason I'm doing it twice is because I'm getting 100 deltas, right? So that's 100 shares. If I did one, I only get 50 deltas, which means I'm really only trading 50 shares and change. So, right? So that actually makes it relative to 100 shares. So you have that. Also, you could possibly, I don't even know if you could do a call ratio or put ratio in here, or just sell puts. I don't even know if it's worth it. I mean, to sell a 12, because I would sell the 12. You're really not getting any money to do anything in here. Yeah, I don't know. I don't even do that. I think the poor man's covered call is the way to go in there, which is the 10-13 call spread, and you do it twice. So that's it on Ford. I can't really see anything else to do, because the problem is that it's going to be real tough to sell premium in here when you got an IV rank of 17. You just can't do it. You kind of do it. You kind of do it. You kind of do it. Let me just bring that up. So you kind of do it. So there it is. That's the trade that I would do for earnings if you're going to do anything. And again, you're going to do it twice. So the quantity is going to be twice, so you're getting 100 deltas. And it's a 50-50 trade. Let's face it, if they do well and the stock goes up, you'll make money. If they don't, you'll lose. That's it. All right, so next on the list is Starbucks. So I'm not even going to write that one up, because it's not, to me, it's not, everyone knows hopefully everybody knows what the hell a call spread is, right? You buy the 10, you sell the 13. That's it. And then Starbucks. Problem with Starbucks is margins usually suck in this stock. So that's right out of the gate. That's usually a problem. Ivy rank at 25.8. Not bad. Again, not bad. Not great, but not bad. Right? Right around where AMD is and where the market is right now for volatility. 25.8 is pretty good. Now, Starbucks has actually done pretty well. In fact, it's actually been quite a beast. Let's face it, since its lows in June when it was 67, Starbucks has been just nothing but a monster. Look at this. This thing's been a monster. I mean, you can go trend line crazy on this stock. And it's all up. Looks extremely, extremely powerful. That's the 1 hour. Let's just bring up the 4 hour. Looks extremely powerful, much, much stronger than many other stocks. I mean, if you were to take this and compare this to a few other stocks, I mean, then nothing looks close to this. So if I'm looking for resistance, I'm going to have to go out more than a 4 hour chart. So let me do a 5-year chart just so I can get some semblance of some resistance up here. And it looks like we're kind of getting to a point here where Starbucks is literally getting near 5-year highs again, back up in the 120s. So I'm just going to call 126, I'm going to say is going to be their resistance. And this has not been happy stock for shorts, that's for sure. That's a 5-year high there. That is interesting. But this stock has been a beast, and it's been worth holding if you own it. But we're not interested in that. We're interested in trading. So I'm going to be looking for calls over 126. And most likely, I'm going to probably look around 100 bucks. Again, the big round, BRN, the big round number, 100 bucks. So probably about 100. So there you go on that. And so probably not going to do May. We'll look at May. I have to do an iron condor. Let's face it. We got a $6 expected move. $6 expected move. 629 in May. And 660. So not really a big expected move here from Starbucks. Going to make it really hard to trade. I mean, here I am at the expected move strangle, and you can see the margins in here. Fucking suck. They suck ass. Yeah, you're not going to be able to do anything in May. There's not enough there to do in May. Let's go look at June. I don't think there's anything here either. Unless you're going to do like I talked about 100. You got to do something like this, like a 105. I mean, this is tight. You got to do something like this. I mean, and this is inside the expected move here in Starbucks. It's kind of a shame. You got to do like a 105, 125 to get any kind of juice. And that sucks. So I don't know if there's going to be much to do in here. Because, with these kind of margins at $1,300, I'm going to have to do an iron condor or be willing to swallow that I'm going to use $1,300. So this is going to be a tough one. This one will be a tough one to do for earnings. I just don't see enough there. Honestly, there's just not. I mean, my gut tells me to do this, which is the 100, 130 in June, but I sure as hell don't want to risk, or I don't want to use $1,100, $1,150 to bring in, let's just say, maybe I bring in $1.10. Look, the stats on this are pretty good. I mean, they're pretty good. They're not great. They're mediocre, fair to middling, if that, maybe even worse, but good probability of profit. Good probability of profit, yeah. Delta is pretty neutral, right? Two little skewed bullish, but for the most part, neutral. This is where I have the biggest problem is. Like no theta in this trade at all. At all. I mean, a 4 theta on a strangle, even though it's 45 days out, that's pretty bad. You know, usually I like to get at least close to double digits on a theta for a strangle. And so I don't know if there's enough juice in here to do anything. And then if you actually do this risk defined, you're actually even taking in less money. So I don't think there's anything to do in Starbucks from a volatility point of view. Maybe one way to play Starbucks, since it's actually had a pretty big run, would be some kind of calendar spread. And the way I would actually play the calendar spread, I would actually play it to the downside. I would actually do like a 125. Let's see, when I do a calendar spread, I usually like to be in the money, and it's usually around 60 plus deltas. So the 120 right now is running at a 65 delta. The 25 is a 79. I'd probably do the 120 put calendar for 340. Yeah, that is where I would sit with Starbucks. And the reason I would be to the short side is because, look, I mean, it's had such a big run. And if it does, like, kind of, hiccup a little bit, which I don't think it is, because every time I drive past a freaking Starbucks around by me, there's always a goddamn line around the corner. I personally don't get it. I mean, if you want sugary coffee, just go stick that caramel shit that you get and put on your ice cream and just stick that in your coffee in your house. It tastes the fucking same. And use a little whipped cream in the can. It tastes the fucking same. Anyway, I don't know. They got whatever it is. They got a market on that, and people love it. So I'm not going to argue with it. I mean, I don't own the stock, so I could care less. To me, it's like, yeah, that's fine. I don't even drink the shit. But needless to say, with this trade, at least no, I'm in the wrong way. I'm the wrong way, and it's the 120, 115. I'll be all right. It's the 120, 115 put calendar for 3. You're getting about 15 negative deltas. There's literally no theta in this. And again, I don't know if you want to play this to the upside, because look where it's run so far. I mean, at some point it's gonna run out of gas. It always does, right? They all do. So if I actually want an earnings trade, to me, that's kind of the place to go. Do the 120, or just do the 120 calendar. The straight up 120 calendar is great, actually. $58. I kind of like that. That's the one I like, the calendar spread. So I'm going with the calendar spread for Starbucks. I like it. It's risk defined. You're going to get a pop on this this is about a 50-50 pop. Let's face it. There's no real great statistics. You're basically directional. You're basically directional on the calendar spread with a little bit of bias in volatility, right? So you're kind of trying to mix two worlds here. There's not really enough volatility to sell premium, but you want to do a trade, and that's really what the calendar spread is. So SBUX, right? It's got an IV rank of a 25.8. This is going to be, I'll be all right, type. Let's move over to the other window. The type, move up. The type is a put calendar. Now, what makes it a calendar spread, right? Same strike, different expiries. If it was a diagonal calendar spread, that would mean it'd be different strikes, different expiries, right? Don't get confused by this. They're all spreads. That's why I keep saying everything is a spread. And then, again, I think this whole industry has created all this bullshit just to confuse people, to make it seem like it's complicated. And it's not. Once it kind of clicks in your head, it's amazing. It's like, oh, okay, now I get it. They've been lying to me this whole time. They're just nothing but a bunch of sleazebags trying to confuse people, make it seem like you need them. So it's a calendar spread, which is going to be a June. So it's going to be a July. Let's do it this way. You're going to buy the July 120 put, and you're going to sell a June 120 put. All right, pretty cheap trade too. Buying power and debit. And this is quoting $58. So $58. Look, the pop on this is 50-50. Right? You're basically delta is neutral. You're plus what? 3 maybe? No theta. It's not even worth mentioning, but I'll put it down. Theta is about a 1.2. And again, the purpose of this trade is really you're trying to be directional with a little bias of the low IV. And you're basically trying to get that long put for free. That's kind of what the purpose of this trade is. In the long run, you're looking for possibly Starbucks to even, blow up a little bit here on earnings, have a down move, and this is where you take advantage of it. Because I think it's a really tough stock, again, for me, as a contrarian, that even if it does go up, I can't really see myself playing this stock to the upside because it does look like it's getting extremely, extremely close to its highs, and probably chances are going to have at least a disappointment at some point where it's going to get clipped. So there you have it on Starbucks. It's the 120 calendar spread, June, July. Pretty simple, straightforward trade, and you could probably do this one anywhere you need to because it's cheap. It's a cheap one. It's a cheapie. All right, so that's kind of it for tonight, right? So we just have AMD and, we talked about Ford too. There's a little opportunity in Ford and a Starbucks. So tomorrow morning, let's take a look at CVS. CVS, great IV rank here, 43.8. Really good IV rank. Let's take a look at CVS on the charts. CVS. I haven't looked at it, so I have no idea. Looks pretty much like everything else right now, right? Big move up, big move down. It's a W pattern. Elliott wave people or whatever. Fuck, who knows? I don't know. I never bought into any of that fucking garbage. It's all fucking garbage. Whatever this is, right? This is just a fucking chop house, just like everything else right now. Probably Lowe's. I don't think you're going to get anything here. Lowe's 52. We got highs at 110. It's at 73. Yeah, we'll see. I don't think there's going to be much in here to do. Let's go to May. Expected move is $3. There's not going to be shit to do. Even though the IV rank is high, it's pretty much right in the middle. There is nothing to do here. With an expected move of $4, you ain't getting nothing. And I'm sure the margins suck on this stock too. Actually, they're not that bad. They're actually not that bad. Let's see. The expected move strangle is a 67.5. 80 for 158, $800 of buying power. Really isn't horrible, to be candid. That's really not terrible. Obviously, wish it was better. I don't know. It's just not enough money for me. I would expect it to be a little juicier with an IB rank of 43. There's really not a lot of juice pumped into these options at all. And a lot has to do with the fact that the expected move is actually tight. If the expected move is a little wider, if it was like $10, you'd probably see a lot better premiums in here. You're just not seeing the wreck. It's going to be a tough one. And yeah, I don't know. It's not enough. And then if you iron condored it, you could do a tight one because they got $2.50 wides. I mean, that's not a bad little trade. And if you could do this, you're not doing this for 66 cents. Let's say you do it for 65. This isn't really a bad trade, especially for folks who haven't done a lot of trades before. And if you haven't done a ton of these earnings trades, this is actually pretty good. And the reason I say that is because look, you got a 62% probability of profit. You are literally on the expected move. You're in a tight iron condor. You're only using $180 to bring in 65. Stats on this are okay. I'm not going to dance in the street for a theta of 1, which is horrible, right? But, look, from a trade point of view, if you haven't done a ton of these, this is actually a good trade. And because, again, structurally, it kind of gets your feet wet if you have never really done these, because it's a very economical trade. You're only going to use $184 of buying power. You're going to bring in 65. You got 45 days to expiry. You're right on the expected move. You're not using a lot of capital. You have a lot of opportunity in this to manage it, right? If your calls get blown up, you can roll your puts up, blah, blah, blah. On the other side, if your puts get blown up, you can roll your calls down. So this is actually a pretty fundamentally decent trade that I'm actually going to be willing to do, again, because it's economical. I'm not really putting a lot of money at risk, and my risk to reward ratio is pretty good in this. So I'm actually going to write this one up, and I think that's going to be it, because the other ones, Yum, Barracks, Wingstop, I'm not even going to look at those. These are usually all shitty ones. Estee Lauder, W. Perion, they all suck for earnings. So usually I don't even, I kind of stick to the ones I've done before. So CVS, we will write this one up, and that will be that. CVS. And so this one, again, this one's for tomorrow morning. So again, you're going to want to do this one at 3:30, just like the others. But they come out tomorrow morning. So you're going to need to be in it for IV rank of 43.8. All right. The type is an iron condor. Okay. Expiry is June. All right, iron condor is always a buy, a sell, and a buy. So again, just for those following along, iron condor is nothing more than a strangle that's covered. That's really all it is. So we're going to buy the 67.5 put. Or excuse me, nope, no we're not. You dummy. It's the 65 put We're going to sell the 65.5 put, and we are going to sell the 80 call and sell the 82.5 call. All right, and so you're going to do that for, so your buying power, you're going to use $185. You're going to do that for a credit of 65. You got a probability of profit of 62%. Delta's neutral for the most part. I mean, it's a negative, -2. And theta is nothing to write home about. But again, structurally is a 1 point, we'll call it a 1.1. All right, and that is your trade right there for CVS. So again, I'm not jumping out of my seat, but I like it because structurally it's good. And especially for smaller accounts, it's perfect because you're not using a ton of capital and you kind of get your feet wet. If you have never really done these before, there's a perfect kind of like introductory trade for doing options. Now, I'm going to throw this out there. Now, if you're a little more seasoned, which I am, but you can widen this out and you're going to bring in a little bit more premium. Okay, so if I widen it out and do 5 wide, which is a more traditional iron condor, you can bring in almost $1, but you're going to use $400 worth of buying power. Right? Changes a lot of the stats too, like 64% pop. You get a little more theta. Your delta is a little more negatively skewed. But you can do that as well. I don't particularly like it only because, again, I'm only bringing in $100 to use 400. To me, that's just, the ratios just don't match. Don't match. I think it's a much more economical trade, and it's more in the wheelhouse to keep this one tight like that. All right. So there you go. And that's it. And that's all we got for today. So we got a number of them. We did, just to sum it up here, we did AMD. We're going to do a strangle, the 80-105 in June. In Starbucks, we're going to do a put calendar, the 120 put calendar, July, June. And in CVS, we're going to do an iron condor, real tight one, 65.5 put spread, and the 82.5 call spread. Put that together, that's an iron condor, right? So you're basically selling a put spread, selling a call spread, put it all together, and it's an iron condor. And that's all we got for earnings and actually upcoming trades. And then again, not really seeing much of anything in the bigger markets. Like, I'm sitting on my hands there. It's just pretty much just a chop house. All right, so there you have it. And have a good one. I hope you like it, and good luck if you decide to do these.